America just lost the last perfect credit rating it had left. Not from an enemy, not from a rival superpower. From Moody's, the same agency that has rated the United States AAA since 1917. Gone. And 200 kilometers north of the border, another country just held on to that same rating without breaking a sweat. This is not a story about politics. This is a story about money, where it's sitting right now and where it's quietly walking out the door to next. If you want to understand what's really happening underneath the headlines, stay with me. I'm Connor Mackenzie. This is Canada Plus 24, and the real story is always the one hiding behind the number everyone else is shouting about. Let's start with the number that should stop you cold. As of this month, the total U.S. national debt stands at $39.5 trillion. Not a projection, not a forecast. The actual number, right now, in July 2026. It's expected to cross $40 trillion by October. Let that sink in for a second. $40 trillion in a country that didn't even reach $10 trillion until 2008. To put that growth in perspective, it took the United States over 200 years, from its founding through 2008, to accumulate its first $10 trillion of debt. It has added roughly $30 trillion more in the 18 years since. The pace isn't just increasing, it's compounding. Independent analysts tracking the Treasury's daily figures now estimate the country is adding close to $1 trillion in new debt, roughly every 7 to 8 months. At that pace, some forecasts put total U.S. debt above $50 trillion before the end of this decade. But the debt itself isn't even the scariest part. It's what happens when a country can no longer service that debt cheaply. On May 16, 2025, Moody's made a decision it had avoided for over a century. It downgraded the United States from AA, the highest rating that exists, down to AL1, one notch. That's all it took to end a 108-year streak. Standard & Poor's had already done it back in 2011. Fitch followed in 2023. With Moody's decision, for the first time in modern history, the United States held 0 AAA ratings from any major agency. Moody's didn't do this lightly. Their reasoning was blunt: federal interest payments. The money the government spends just to service what it already owes are on track to consume 30% of all federal revenue by 2035. In 2021, that number was 9%. In 2024, it had already climbed to 18%. That's not a slow drift. That's a curve bending upward faster than almost anyone in Washington wants to admit publicly. Here's what that actually means in real dollars. The U.S. now pays over $1 trillion a year just in interest, more than it spends on national defense. In 2020, that interest bill was $345 billion. It has nearly tripled in 6 years. The Congressional Budget Office projects it will hit $2.1 trillion annually by 2036. Over the next decade, the total interest bill alone is projected at over $16 trillion. Money that builds no roads, funds no hospitals, strengthens no military. It just pays for yesterday's borrowing. For every dollar Washington collects in taxes this year, about 19 cents goes straight to interest. By 2036, that's projected to rise to 26 cents of every dollar. Follow that line far enough, and by 2048, interest on the debt becomes the single largest line item in the entire federal budget. Bigger than Medicare, bigger than defense, bigger than anything else Washington funds. Ray Dalio, one of the most respected macro investors alive, didn't call this a recession risk. He called it something closer to a heart attack. Not the kind of shock a country recovers from in 2 quarters, the kind that changes the entire system afterward. And it isn't just retail commentators sounding the alarm anymore. In April 2026, the IMF issued a warning that deserves far more attention than it got. The fund formally acknowledged that U.S. debt had lost its traditional safety premium relative to other sovereign borrowers, language the IMF almost never uses about the world's largest economy. Apollo's chief economist added another layer to the concern. Hedge funds now hold a record share of outstanding U.S. Treasury securities, and much of that position is financed with heavy borrowing, using those same treasuries as collateral. When a market gets that leveraged on one side, any forced unwind, a margin call, a liquidity squeeze, doesn't stay contained. It ripples through global bond markets fast, and it ripples hardest through the market that's most leveraged, which right now is the U.S. Treasury market itself. That's a structural fragility that simply doesn't exist in the same way in Canada's bond market. Canada's banking sector remains well capitalized. Its bond market carries far less speculative leverage. The OECD's most recent economic survey of Canada described its macroeconomic framework as fundamentally robust, with enough of a fiscal buffer to absorb shocks from ongoing U.S. tariff disruption. That buffer is precisely what global capital is willing to pay a premium to access right now. And here's where this stops being an American story and starts being a Canadian one. When Moody's stripped away America's last AAA rating, only a small handful of nations on Earth still held that top-tier status across the board. Germany, Switzerland, Australia, Singapore, Norway, and Canada rated AA by Moody's and AA by Standard & Poor's. Now, to be precise, because precision is the whole point of this channel, Fitch actually downgraded Canada to AA+ back in 2020, and it hasn't moved that rating since. So Canada isn't a perfect clean sweep across all four agencies. But on the two ratings that matter most to the largest pools of global bond capital, Canada sits in exactly the company the United States just fell out of. That distinction matters more than it sounds like it should. When the world's benchmark safe haven loses its top rating, trillions of dollars in institutional capital, pension funds, sovereign wealth funds, central bank reserves, don't just sit still. They start looking for the next safest port. And Canada, sitting where it does, is suddenly on a very short list of alternatives. Let's be fair to the full picture here, because Canada is not without its own pressures. Federal debt sits north of $1.2 trillion. The Carney government is projecting a deficit of $78.3 billion for the 2025-26 fiscal year, the 10th consecutive year without a balanced federal budget. Every child born in Canada today inherits a share of that debt. This isn't a story about Canada being flawless. It isn't. But here's the number that global capital actually cares about: debt as a share of the overall economy. Canada's deficit sits at roughly 2.5% of GDP. America's deficit is sitting close to 6% of GDP, more than double. When institutional investors run their models, that gap is what moves capital. Not headlines, not politics, ratios. Before we go further, this is exactly the kind of gap between what gets reported and what's actually verified that we built the Canada Plus 24 Power Play dossier to track. It's a complete, sourced record of every major move in this Canada-US story. QSMA, the CPKC merger, the bridge deal, all of it, cross-checked the same way we just checked these numbers. There's a link in the description if you want the full picture in one place. Now, back to where this money is actually moving. In April 2025, something happened that historically doesn't happen. When markets panic, the US dollar has always been the safe harbor, the currency everyone runs toward. During that month's tariff shock, investors did the opposite. They sold US assets and the US dollar at the same time. The Bank of Canada's own financial stability report flagged it directly. Researchers at the Hoover Institution later documented that this dollar erosion wasn't even new. It predated the tariff shock. The shock just exposed a trend that was already quietly running underneath the surface for longer than most people realized. So where did that capital go? A meaningful share of it went into gold. Gold is not a small detail for Canada. It's one of the country's major export commodities, and Canada ranks among the world's largest gold producers. Through 2025, gold prices climbed sharply, and forecasts from major banks pointed toward continued strength into 2026. JP Morgan's own CEO suggested gold could eventually reach $10,000 an ounce in a sustained de-dollarization scenario. Whatever the exact peak turns out to be, the direction is not in dispute. Central banks around the world have been steadily increasing gold's share of their reserves for several years running. TD Economics flagged something in its early 2026 reporting that reinforces exactly this pattern. Portfolio flows out of the US and into Canada were notably strong through 2025, and almost all of that movement came through one specific channel: Canadian government bonds. Foreign direct investment into Canada reached roughly $40 billion through the third quarter of 2025 alone, running meaningfully ahead of the same period the year before. At the same time, Canadian public debt issuance hit one of its most active years on record by volume, with provincial offshore issuance setting a fresh high. In plain terms, the same global investors stepping back from US Treasuries were, in the same stretch of time, stepping toward Canadian government debt instead. None of this shows up as a single dramatic headline. It shows up quietly in bond auction results and quarterly capital flow data, month after month, without ever making the evening news. But it adds up to one of the more significant undiscussed financial stories of the past 2 years. A slow, steady reallocation of global capital away from the world's traditional benchmark safe haven and toward its more fiscally disciplined northern neighbor. Then there's the pipeline story, and this one doesn't get nearly enough attention. The Trans Mountain expansion had its first full calendar year of operation in 2025, and it changed something structural. Western Canadian crude started flowing directly into Asian markets at real scale for the first time. China, South Korea, Singapore, and Hong Kong all became new buyers of Canadian energy that simply didn't have this access before. That's not a headline. That's a permanent shift in where Canadian oil finds its customers. At the same time, Canada's trade relationships have been diversifying in a way that would have seemed unlikely just a few years ago. The share of Canadian exports going to the United States has declined from roughly 76% to closer to 68%, while exports to the rest of the world have picked up the difference. The UK moved past China to become Canada's second largest export destination during the 2025 trade disruption period. Singapore, Germany, Japan, Brazil, all growing as Canadian trade partners. This isn't Canada retreating from the US relationship. It's Canada refusing to be dependent on any single customer. Global Affairs Canada's own trade data backs this up at the sector level. Through the trade disruption of 2025, resource-driven sectors, agriculture, forestry, mining, oil and gas extraction, kept expanding even as manufacturing, which is far more exposed to cross-border supply chains with the US, slowed down. That's a meaningful divergence. It suggests the parts of the Canadian economy most tied to global commodity demand are the parts absorbing the shock the best, while the parts most tied to integrated US supply chains are feeling the most pressure. It's not a complete decoupling from the American relationship. The US remains Canada's largest trading partner by a wide margin, but it is a real, measurable shift in where the marginal dollar of new growth is coming from. Critical minerals are the other half of this story, and it's arguably the bigger one long term. The global economy is racing toward electrification, and that means an enormous, sustained demand for lithium, copper, nickel, cobalt, and rare earths. Canada holds some of the largest reserves of these materials on the planet. Sovereign wealth funds have been taking direct positions in Canadian mining companies. The Qatar Investment Authority's investment in Toronto-listed Ivanhoe Mines wasn't a casual portfolio move. That's a strategic bet on Canadian resources by a state actor with a multi-decade time horizon. And in one of the largest deals of the year, Anglo American and Teck Resources announced a merger worth over $50 billion, with the combined company headquartered in Vancouver, instantly making Canada home to one of the world's largest copper producers. The Canadian government has backed this with real money. Billions in new critical minerals programs announced at the March 2026 PDAC convention alone. Over 200 active mines across the country now produce more than 60 different minerals and metals. The Fraser Institute continues to rank British Columbia and Ontario among the most attractive mining investment jurisdictions on Earth. The International Energy Agency's most recent critical minerals outlook projects that demand for materials like lithium and graphite could rise by an extraordinary multiple over the coming decades as the global energy transition accelerates. Whoever holds the reserves holds genuine long-term leverage in that transition. And Canada is one of a small handful of countries positioned to be a dependable, stable supplier at the scale the world is going to need. That's not a short-term trade story. That's infrastructure for the next several decades of the global economy. And it's being built, in part, with capital that's actively looking for an alternative to US fiscal uncertainty. There's also a currency dimension to this that most financial commentary misses entirely. As global reserve managers diversify away from an overweight position in US dollars, they're not moving everything into a single alternative. They're spreading it across a basket of currencies from smaller, fiscally stable economies. The Canadian dollar has been explicitly named among the currencies picking up a larger share of that reallocation. It isn't replacing the US dollar. Nothing is doing that anytime soon. But every time Washington triggers a new fiscal scare, and every time Treasury yields spike on deficit concerns, the loonie and Canadian bonds have tended to catch a modest, quiet lift. It's not dramatic. It rarely makes a headline on its own. But it shows up, consistently, in the flow data, quarter after quarter. None of this happened by accident, and none of it happened in a vacuum. Every one of these threads, the bond flows, the gold, the pipeline exports, the mineral investment, the trade diversification, is connected to the same underlying force, global capital looking for stability at the exact moment Washington's fiscal credibility came into serious question. Prime Minister Mark Carney said it plainly at Davos earlier this year. He called Canada a safe harbor. That's not just a talking point for a domestic audience. That's a pitch aimed directly at global capital, and the data behind it is real. Canada issued a US dollar-denominated global bond in May 2026 specifically to diversify its reserve base and signal to international markets that it's playing a global game, not just a regional one. The government has committed to maintaining liquid foreign reserves at or above 3% of nominal GDP, a level of fiscal discipline that would be politically almost unthinkable to even propose in Washington right now. Here's the thing about a story like this. It moves fast, and the headlines rarely keep up with the actual data. That's the entire reason the Power Play dossier exists. It's not another video essay. It's a sourced, fact-checked reference document that lays out every major deal and every verified number in one place, so you're never relying on a headline that got the figure wrong. If you've made it this far, you're exactly the kind of viewer this was built for. The link is in the description below. Zoom out even further, and the picture gets more interesting. The OECD's global debt reporting shows sovereign bond debt across its member nations climbing towards some of the highest levels recorded since the years right after the pandemic. A meaningful driver of that increase is currency-related. As the US dollar has weakened over the past several years of trade turbulence, it has effectively inflated the dollar-denominated value of debt held around the world. But that same dollar weakness cuts the other way for a resource exporter like Canada. When the currency you're pricing your exports in gets weaker relative to buyers overseas, your goods get cheaper for the rest of the world to purchase. It's a structural, almost invisible subsidy running from US fiscal dysfunction directly into Canadian export competitiveness. And it compounds every single quarter the imbalance continues. Let's put the two trajectories side by side, plainly, one more time. The United States, a deficit near 6% of GDP, $39.5 trillion in total debt, 0 AAA ratings left anywhere, and an interest bill that's on pace to become the largest single item in the federal budget within a generation. Canada, a deficit near 2.5% of GDP, real fiscal pressures of its own, but still holding top-tier ratings from the two agencies, global capital weighs most heavily, a resource base the entire electrified global economy needs, and a currency quietly picking up a larger share of a reserve pie that's actively being rebalanced away from the US dollar. Neither country is perfect. Canada has its own deficit problem, its own debt-to-GDP pressure, its own tough conversations still ahead. This isn't a story about Canada being flawless. It's a story about relative direction, and capital, at the end of the day, doesn't care about flags or headlines or political rhetoric. It follows the direction of travel. Right now, in the summer of 2026, that direction is bending north. None of this happened because Ottawa executed some brilliant, coordinated master plan. Most of it happened because Washington's fiscal dysfunction created a vacuum and capital, which moves faster and more honestly than any press release, filled that vacuum with whatever looked stable nearby. Canada happened to be standing in exactly the right place, with exactly the right combination of resources, ratings, and relative fiscal discipline, at exactly the moment the world started looking for an alternative. That's not a guarantee it stays that way forever. Fiscal positions shift, ratings get reviewed, political winds change on both sides of the border. But as of today, in the summer of 2026, the data is what it is, and it points in one direction more consistently than almost anyone in mainstream financial media is willing to say out loud. We started this video with a single number. The debt rating America held for over a century and lost in a single afternoon in May of last year. That number set off a chain reaction most people never got to see. Bond flows shifting, gold surging, pipelines redirecting trade, mining investment accelerating, and a currency quietly gaining weight in reserves it never used to touch. That's the real story behind the headline. Not America's crisis alone, but where the world decided to put its money instead. If you want the complete, verified record of exactly how this played out, every deal, every number, cross-checked and sourced, not summarized from a headline, that's exactly what the Canada Plus 24 Power Play dossier is built to give you. It's a one-time purchase, $37, yours to keep permanently, no subscription. And for the next 48 hours only, starting from right now while you're watching this, you can get it at 44% off using the link in the description below. That discount closes in 2 days. After that, it goes back to full price. If you've sat through this entire breakdown because you actually want to understand where this is heading instead of just reacting to the next headline, this is the document that keeps you ahead of it. Go grab it before the window closes. I'm Connor Mackenzie. This has been Canada Plus 24. Subscribe if you want the numbers before anyone else reports them, because the real story is always hidden in the data nobody bothered to check.